I think there are a number of key trends that we're seeing take shape in the U.S. asset management industry right now. And as you alluded to, these are trends that ultimately take shape at different rates of speed in other markets around the world. One of the more interesting trends that we've seen that now has really taken its current form over the course of now 30 plus years is a move away from mutual funds to other investment vehicles, other investment wrappers. And most notably, the shift from investors allocating money to mutual funds to now increasingly exchange-traded funds, or ETFs. So ETFs in the United States were born in 1993. We're here now nearly in 2026. And what started as just one fund is now many thousands of funds. I noted earlier this year that in the US market, there are now actually more listed ETFs than there are listed stocks. So the number of ETFs outnumbers the number of US listed equities. Very soon, what we'll see is that there will be a moment where the number of US listed ETFs will actually outnumber the number of US mutual funds as well. And that has a lot to do with investors' preference for the ETF wrapper and in many of its benefits. So somewhat unique, though not entirely unique to the US market, is that the ETF wrapper is more tax efficient for investors that are investing in a taxable setting and have been in many cases, in 2025 is no exception to this, been receiving taxable capital gains distributions from their mutual funds with increasing frequency and also ever larger magnitude near the end of the year. This sort of tax cost has led many to prefer the ETF wrapper, which for a variety of reasons is more tax efficient. But I think also importantly, the ETF wrapper is just more convenient and compatible and accessible to a greater number of investors, from very large institutional investors to individual investors. It gives many individual investors access to a variety of different types of investment strategies with very low investment minimums, oftentimes at a very low cost, in a way that is immediately accessible to them. And that could take any number of different forms. It could be them allocating via their brokerage accounts. It could be them engaging with effectively a so-called robo-advisor. So an online platform that allocates their monies in very small increments, sometimes as small as just $1, to a completely diversified portfolio. So I think this has really been revolutionary to the extent that now even the very smallest investor can add $1 to a multi-asset ETF portfolio and get $1's worth of exposure to virtually every listed public equity and public fixed income security on the planet Earth. To start to sort of categorize the factors that I see as driving this, I would start with sort of the longer term secular factors that are at play. And perhaps the most prominent one is just the evolution of the US investor base and where the portion of the US investor base, so largely baby boomers in this moment, are in their investment life cycle. So baby boomers, many of whom are already in retirement, the last increment of them is about to enter retirement, are at that phase in their investment life cycle where they're no longer accumulating assets to fund their retirement, but they're beginning to spend those assets. So in many cases, it's only natural that you would begin to see outflows from certain of their holdings because they're not adding to them, they're drawing on them to pay their bills, to go on holiday, you name it, as they're in retirement. The other element there is that naturally as they get into retirement, they want to begin to de-risk their portfolios, to shift their overall asset allocation further away from equities and further towards fixed income. Now, concurrently, the cyclical factor that is further accelerating that trend is the fact that within the US now, interest rates are at levels we haven't seen in quite some time. And in real terms, so after you account for inflation, are positive, which is not something we've been accustomed to for the preceding decades. So certainly from the perspective of that cohort of individuals I described, the baby boomers, either spending their way through retirement or about to retire, that's very appealing for them. They can begin to take risk out of their portfolios. They can reallocate more to fixed income securities that are generating a level of income that is going to help them to further fund that retirement spending need without necessarily sort of encroaching on their principal that they've invested. So those factors, I think, are the biggest sort of secular and cyclical drivers of that shift as you've described it. The other cyclical factor at play right now is that many US investors have enjoyed a fairly sort of benign market environment. The stock market has been generally positive. Yes. We've had some bouts of volatility, but in the grand scheme of things, nothing like what we had experienced during the global financial crisis. Nonetheless, what we see is that there's really a small handful of individual securities that have powered the US equity markets higher, the so-called Magnificent Seven. And I think many investors are concerned about the level of concentration in US equity markets, about lofty valuations in US equity markets, and have begun to reallocate some of their equity exposure away from their home market, the US market, and towards international markets, among other strategies as well. There are also a number of other equity sort of exposure strategies and vehicles, even something as simple as equal weighted strategies that investors are also looking to try to mitigate their exposure to these small handful of very large, very successful firms that are all increasingly looking to capitalize on one key global theme being artificial intelligence. So this is just another means, I think, of de-risking. In one part, it could be allocating more money to international equities. It could be rethinking even strategies within their domestic equity exposure.
Okay. Regarding the international equities, are there any specific regions they choose the most?
It's a good question. Generally speaking, I think the other key secular trend we've seen within the industry, I described earlier the shift away from mutual funds and towards ETFs, separate accounts, collective investment trusts in the US retirement space. The other big shift we've seen is towards, when thinking about not the package but the strategies, away from discretionary active strategies and towards indexed strategies, whereby, depending on how you measure the market, certainly if you just look at the US funds market, inclusive of ETFs and mutual funds, the assets under management in indexed strategies actually eclipse those inactive strategies. So when it comes to investors' choices with respect to how they allocate to international equity markets, increasingly that's done using a very sort of broad market cap weighted indexed approach. That could be a total sort of global ex-US market exposure. It could be a developed ex-US market exposure. It could be a combination of developed and emerging markets within a portfolio context, but increasingly in the context of, again, a broadly diversified equity exposure. So it's not as though, for many investors, they're trying to select whether any one particular market, be it Korea or Japan or China or Brazil or South Africa, is going to do better than another. They're happy to index ex-US markets in much the same way that they're indexing oftentimes their exposure to their home market. No, not very common at all in Japan, but very, very common right now in the US.
I'm curious about that.
Yeah, so it's a product set, so both leveraged in inverse and inverse leveraged exchange traded funds in particular first became popular in the US market really around the time of the global financial crisis. there was a brief period whereby the SEC actually had a moratorium on the issuance of any new product from new providers. So there were two issuers of these funds in the US, ProShares and Direction, that effectively had a moat built around their business by virtue of this SEC moratorium that's since been lifted. So what you've seen once that's been lifted is that there are more firms that are offering products in this space, and the number of products has expanded nearly exponentially. So while the first products would try to go either leveraged long or say leveraged short the S&P 500 or the NASDAQ or the financial sector, more recently what you've seen is an explosion of leverage and inverse products that have exposure to an individual stock. So MicroStrategy is an example. So the thing to note about these funds and how they perform and whether or not they perform as one might expect is that the leverage factors that they employ reset on a daily basis. So depending on how volatile the return stream is of the underlying asset, over a long period of time, that actual experience could be very different from a simple 2 times positive or 2 times negative or 1 times positive, 1 times negative, the performance of that underlying either index, like the S&P 500, or individual stock. Nonetheless, there's been significant growth, especially in those individual stock products. And anecdotally, what I've heard from a number of the issuers of those products is that most of the demand is actually, despite the fact that these funds are listed in the US, it's coming from overseas. And it's coming from markets actually like Japan and like Korea. And what you're seeing is that more and more US exchanges and brokerages are looking to offer sort of 24-hour trading in some of these products so that their clientele overseas are able to transact in them in a way that's more liquid and more readily available to them, so that they're not having to, either wake up very early or stay up very late to be able to transact in these securities.
So I don't think individual investors can allocate these kind of products by themselves.
They probably shouldn't, but what I've heard anecdotally is that many are, and that certainly has been where there's been, I think, the greatest appeal. There's been an absolute sort of explosion in the number of, especially exchange-traded funds that don't look like funds as we tend to know them. And again, I think these leveraged single stock ETFs are probably the most prominent example. And what I've heard and what we've seen is that it's actually individual investors that gravitate to them, because there's just kind of, I think certainly it's the experience right now in the US market, a bull market and just like rampant speculation, especially among younger investors who have grown up with cryptocurrencies and the ability to bet on sports games on their mobile phones. So it very much has an appeal to a very specific demographic, which tends to be younger, it tends to be more so male, that want that like immediate and very large payout, but oftentimes at the risk of losing a lot of money in the process.
Makes sense.
Yeah.
Thank you.
Yeah, so I think first and foremost, it's important to understand that there are so many flavors of multi-asset strategies.
Yes.
So if you're to look in the US market where multi-asset strategies have had the greatest success, I would point to the retirement space and specifically defined contribution plans, whereby now that various target date funds and series of target date funds have become the default option for more and more US workers in their employer-sponsored retirement plan. You've seen tremendous success, tremendous adoption, and market improvement just in plan participant outcomes based on no longer defaulting to, oftentimes the default was a cash account or something like a stable value fund. Now you can just have one selection that aligns with the date that you aspire to retire on, that is professionally managed, is very low cost, and you can simply set that option and almost forget about it. So massive success within that landscape. Once you get outside of the retirement landscape, there's different types of model portfolios. So one and done, just asset allocation portfolios and mutual funds have had a very hard time getting traction with advisors in particular, because advisors view their value as building that multi-asset portfolio themselves. So they don't want to be in a scenario where they recommend, and it could be a perfectly suitable multi-asset fund for their clients, and then their clients get their account statement and they see one fund and they say, well, what am I paying you for? I could have bought that fund myself. So those one and done asset allocation funds within the advice and wealth landscape are going to have a very difficult time gaining traction. But what you are seeing significant growth in is all form of what we call model portfolios. So increasingly asset managers, instead of, and maybe not instead of, but in addition to offering one and done asset allocation products, are building model portfolios and series of model portfolios. And in the first instance, these were comprised almost exclusively of their own proprietary funds. More recently, they've become more open architecture, so they may combine their funds and even some of their competitors' funds. This is happening at the level of the asset managers, so all of the large global asset managers are doing this. BlackRock has probably been the most successful and is looking to replicate that success now in a variety of different markets, be it through ETF savings plans with bank partners in continental Europe, through direct-to-consumer apps like is manifest in their partnership with Jio in India, because at the end of the day, they can take their multi-asset expertise and express that in a variety of different formats. So model portfolios are really, I think, especially for the next generation of advisors in the US, going to become the default with respect to how they go about building portfolios for their clients. That frees up more of their time, and we've done a lot of market research with advisors to try to understand why they like models, how they use models, and more so than anything, it allows them to build their business, to scale their business, and to free up more time to do other things for their clients, from tax planning to estate planning to helping with the sales of family-owned businesses, you name it. So model portfolios, I think, are the single most interesting trend in just kind of the multi-asset landscape in the wealth channel in particular. And then, as I alluded to with the BlackRock Jio example, when you come to like direct to consumer applications, that's often delivered digitally via some sort of robo-advice model. So again, what you arrive at is some form or another of multi-asset portfolio, but it's not just one fund, it's a fund, and oftentimes you'll fill out like a risk tolerance questionnaire or something to make sure that that portfolio is matching with your sort of ability, your willingness to take risks, your return objectives, what have you. I would say that the key factor for most sort of core model portfolio series is just standard like mean variance optimization. Where do I want to plot on the efficient frontier?
Target return or target risk?
Exactly. But you're beginning to see evolution away from that as manifest in model portfolio series that have specific income objectives.
Income.
As manifest in, and I mentioned target date series before, target date series that now have a glide path that will terminate with an insurance product and an allocation to an annuity that will generate income for that investor through their retirement. Even actually just this morning, Vanguard announced that they're going to launch a new target date series that will have exactly such a structure. It'll have an embedded annuity to generate retirement income for investors. So there are at the edge evolutions away from just simple, efficient frontier plotting risk and return objectives, and I think most notably towards income objectives, because I think, especially for retirees, their most pressing question, especially I think in a U.S. context, is, am I going to have enough money, to comfortably retire, live my life in retirement the way I want to live it. Yeah. Yeah, I mean, I think most customers and investors are perfectly happy and perfectly well served. There is like a small but vocal crowd that thinks that investors deserve better. And to the extent that there are alternatives, even Morningstar ourselves, through our own retirement business, increasingly look to meet those needs through just managed accounts. So it's very similar to, in kind of overarching objective and shape, to a target date retirement fund, but more specifically cut to fit that investor's specific needs and preferences. So the outcome, and we have this even within our own retirement plan, I'm internally a client of this service, it knows more about me specifically, so it can fine-tune my portfolio a little bit better than a Vanguard 2065 target date retirement fund might be able to do. So there are alternatives, but I think anyone who wants to speak poorly of target date funds, at a minimum, has forgotten how bad it was before we had target date funds. So yeah. Annuities are popular. They were less popular for a period of time for a variety of reasons coming out of the global financial crisis. Part of that was just rates on fixed annuities were very low. Part of that was just some of the issuers of the annuities, some of the backers were financially sort of challenged. So for a long period of time, largely just based on the level of interest rates, they had become far less compelling. It's also a market that historically, the incentives have been such that they benefit the seller of the annuity, maybe much more so than the buyer of the annuity. So I think the level of transparency and competition probably can continue to increase for the better and for the benefit of the end investor. But I think if we're going to see, I think both of those things advance. I think the emergence of these new target date products is going to be a key driver of exactly that outcome, because Vanguard in particular has a very long history of bringing pressure on fund costs, fund fees, and sharing the benefits of those lower fees in turn with the investors that it serves. So, and it's brought really the entire industry along with it now over the course of the 50 plus years that it's been in existence.
Okay.
So I think when you look at saturation in particular, what you've seen for those firms is that their traditional sort of investor clients are fully, if not over-allocated. And those are largely larger institutional investors, maybe some high net worth, ultra high net worth wealth clients. So increasingly where they're looking to raise capital is within the wealth channel, coming further downstream where average allocations are very, very low today. That presents challenges, opportunities, a whole host of different things. I think the appeal, for many wealth investors is no different, or driven by many of the same factors that I described earlier. So the evolution of just the investors and where they're at in their life cycle, and especially the investors that have most of the money, the baby boomers, looking now more so for income than they are necessarily equity exposure. So if you look at the success of private credit products in particular, many of which boast distribution yields that are 10% or so, and also have at least very low perceived volatility, that's very appealing, and it's also a very easy sell to your clients if you're an advisor, to say there's this private credit product that will give you a 10% distribution yield, and you will sleep well at night because its NAV barely even moves. So I think there's going to continue to be more growth there, both via sort of individual product level sales. What you're seeing too is many of the large managers, either unto themselves or via partnerships, are looking to develop series of model portfolios that will include an allocation to one or more private markets asset classes. And you're also seeing similar partnerships in the target date space, in target date CITs or collective investment trusts, which is probably the most natural home for some of these less liquid, longer lived asset exposures, considering the time horizons, especially of just emerging retirement investors. So the prospects, at least on paper, look bright within the space. Asset managers certainly find this attractive because the margins on private products are much higher than they are on plain vanilla index funds. So they have their own sort of economic incentives and motivations. Just how far this will go, I think, is the big question that many are asking. And also just how much money can flow into these asset classes before some of what makes them appealing today begins to diminish. So I think in private credit in particular, one would expect, just based on the way that we know markets work, that the more money that's allocated to private credit, the lower those spreads will become, and thus the lower expected returns there will be. And all of a sudden the trade-offs with respect to liquidity and the fees that these funds charge might look less compelling. So there's still, I think, as we sit here today, a lot of questions about just how far this trend will indeed go or can go. I think it's very difficult for most individual investors, and I think most individual investors have plenty of options already available to them that are going to help them to meet their investment objectives, without having to add more complexity, more fees, also less liquidity to the mix within the context of their portfolios. But I certainly think for those that are very savvy, that understand the risks, the prospective rewards, and the fact that the rewards may not actually materialize and are willing to assume that risk nonetheless, certainly these asset classes could have a place in their portfolios. But it's a high hurdle to clear. So I think most individual investors are just best served by diversifying very broadly, keeping costs and taxes as low as they can, and finding a hobby that they enjoy other than watching the markets all day.
Okay, thank you.
Yeah, I mean, Bitcoin ETFs are an interesting case study to the extent that Bitcoin was once a very exotic asset that traded, on an exchange that was named after a card game exclusively, and now it is packaged in regulated, registered investment products and traded all day, every day on the New York Stock Exchange. Dramatic evolution. And I think it has evolved in that direction in, no small part because the convenience, the level of safety, the level of transparency, just ease of use especially as packaged in an ETF vehicle specifically, has, and we've seen that as manifest in all the flows into these products, a lot of appeal to a lot of investors and a lot of investors globally, right? Because I think it's easy to forget that for ETFs in particular, the prospective investor base is much more global than it is for traditional mutual funds. That just about anyone who can tap into and trade on the New York Stock Exchange, irrespective of where you're from and who issued your passport, like you can have that access point in the way that mutual fund markets have tended historically to be much more closed. So it's also, I think, very much a global phenomenon, regardless of the fact that in certain markets, some of these products are still not live for a variety of reasons, largely regulatory in nature.
Okay. Do you recommend to investors to have some portion of Bitcoin?
I don't have any recommendations. I myself have a very small allocation, largely just because I wanted to have firsthand experience with the asset. And when I say very small, it's less than 25 bips of my overall portfolio. Okay. Just to have direct experience with different access points, including ETFs as well as direct ownership, just to better understand the asset and how it transacts. I think again it comes back to what is an investor's willingness to deal with the risk, and we've seen that risk manifest itself again. There's been a significant drawdown here in recent weeks. And do most investors need it? Absolutely not. I don't think so. I still, I grew up in a research background. I, was in equity research once upon a time and had to build discounted cash flow models. And there's no discounted cash flow model for Bitcoin.
Yeah.
There's no earnings calls.
Yeah, exactly.
I'm going to borrow a few messages from the late John Bogle, the founder of Vanguard, who I think has inspired me and many others. One of those is to stay the course. Markets are volatile, but it turns out that that's just the price of admission if you want long-term returns that are going to get you to where you want to be financially. The other one, is he was fond of saying, don't do something, just sit there, which is related to stay the course. So especially in moments like we experienced earlier in 2025, the best thing you can do is often absolutely nothing. And then the last piece of wisdom that he shared that is the closest thing to the law of gravity in financial markets is that costs matter. That the less that investors pay, either directly or indirectly, via taxes, via fund fees, via just trading activity, the more you're going to wind up with. And that is very different than what we're accustomed to in other settings where we are consumers, right? When you pay more for a car, I expect to get a Lexus and not a Toyota. It turns out when you invest, it's actually the exact opposite.
Okay. Thank you so much for your insightful message. Thank you again for your time and for this incredibly informative interview.
Yeah, thank you.
So it was a pleasure to speak with you.
Likewise.
Thank you so much.
Thank you.
Thank you.